Pat Mannix, partner, Paris Financial, the small business tax champions. I want to talk to you about a trading company structure for small business. I've been known to bag trading company structure for very good reasons, but they do have their place, and I'll go through a trading company structure now. So a trading company structure has no trust involved at the peak level. It's a proprietary limited company which is running your business with no trust involved. So with a company, you do get limited liability, so it protects directors and protects directors' personal assets as long as you structure correctly. So obviously a real strength of a trading company structure. The second thing is a lot of people find it very simple and able to manage their cash flow better with a company rather than, for example, a discretionary trust, because companies pay their own tax. So in a family trust, you've got to distribute that profit of the business down to either an individual or another company who pay the tax. A trading company, they pay their own tax. So it's simple from that perspective. The other thing about a proprietary limited company is that it can issue dividends, and they go straight to those shareholders. Again, a trust is more complicated. Now, a proprietary limited trading company is generally good for two types of business. One is the business that is not going to grow, but there's a demand from the industry to run a company. Now, example of these can be your IT person who is working mainly for one or maybe two payers or employers. Payers, that is an example. So an IT person just getting paid by the one or two payers. Another very good one are truck drivers or courier drivers, where they're generally going to get a limited amount of income in their business. However, the industry demands that they run their own proprietary limited company. There are two good examples there of where you would look at a trading company structure to run your business. Industry is demanding it, and you're not going to get a lot of growth. The other business that really requires a trading company structure is when your business is starting to grow and grow and grow. And you're generally talking about upwards of $10 to $15 million in turnover, and you're looking at developing your business so that third-party entities are starting to look at you. So that could be investors looking at wanting to invest in your business. You may have other government authorities like ASIC and auditors looking at your business as well, and potentially banks too. So if you're growing to that level of business, $10, $15, $20 million turnover, you'll then look to maybe go to a trading company structure so everyone can understand it. Auditors can audit your business for assets, and it's very, very common for startup businesses in the tech space to be developing a company structure because they're going to grow. They're going to get high-level private equity people investing in their company, and a company is going to be the only way to go. One other reason why you would run a company for your business is, and this is quite typical for startup tech type companies, is if you're going to run research and development and claim the R&D tax concession by the tax office. So that can only be done via a company structure. You cannot claim R&D if you're running your business through a family trust or a unit trust. So companies, very, very small, courier drivers, IT contractors, those types of very small businesses that have got a limited amount of income and growth in their business are fine for proprietary limited companies. Bigger businesses, where there's demand for a proprietary limited company via third-party potential investors, other government organisations, or to do R&D, go for a proprietary limited in that space. Everyone in between, growing small business, companies can be a bit of a disaster. One of the main disadvantages to understand companies from a tax perspective when it's a growing small business is that companies do not get the second capital gains tax discount. So I'll give you an example. If you've got a business running in a company structure and you started it and 5 years later, you sold the business within that company for $1 million, you will get one capital gains tax discount, which is worth 50%. So instead of paying tax on $1 million, you'll pay tax on $500,000 in a company structure. Okay, however, if that business is running under a family trust, you will get two capital gains tax discounts. So instead of a taxable amount of $500,000 in a company, in a family trust, the taxable amount is $250,000. And that's not the end of the problems of a company with capital gains tax. So massive disadvantage in that, in a growing small business, in a company structure. So be aware of it. Be aware of trusts. Make sure you get the right advice. But proprietary limited companies, they have their space in the Australian business community, either very small or very big. In between and growing, no way. Any questions? Come and chat to us. We're Paris Financial, the small business tax champions. See you next time.